Who's next? It's the question many business owners face because it means creating succession strategies for the future of their businesses. The issues were discussed at an event September 25th at the Whitby Castle in Rye, presented by Webster Communications, publisher of the Westchester and Fairfield County Business Journals and WAG Magazine, and presenting sponsor Webster Bank. Moderator and keynote speaker was Andi Gray of Strategy Leaders Incorporated. Guests heard from Joseph Bodan, partner at the accounting firm PKF O'Connor Davies, and Gregory Kearney and Nicholas Marra, both senior vice presidents at Webster Bank.
As we think about moving on, it's important to look at the definition of what succession planning is, which is ensuring that the business has opportunity to continue as a viable entity when the current leaders move out of the way. Historically, when you would ask business owners what did they expect to do with their business, it was about a 50-50 mix. Give it to the family or move it on to someone in the family or sell it to outsiders. And while that was the thought process, even as recently as 5 or 10 years ago, the numbers in terms of outcomes were actually very different. So about 15% of businesses actually got to generation 2, and another 5% actually made it to generation 3. So while 50% thought they were going to get the family engaged, didn't happen so much. For those who are planning to sell, 20 to 30% of businesses that go to market actually sell right now. That's an EPI, State Planning Institute number, and it's also backed up by Biz Buy Sell. And so what that really means is that about 1 in 5 businesses that is attempting to sell actually gets it across the line.
Consideration should be given to being an S corporation, because you don't know whether you could buy, whether the deal is going to be selling assets or stock. The buyer usually wants to buy assets so they can get a step up in the basis. In a C corporation, that's double taxation. If you're selling the assets, then it's taxed again when you distribute it out to the shareholders. So if you turn it to an S corporation, the profits during those 5 years increase your basis. And if you do happen to sell stock, you'll have less of a gain that way. And if you sell the assets, it's still only one level of tax. If you have to wait that 5-year period when you convert.
Where do I put a team together when I'm ready to sell my company or I'm ready to move to a different retirement solution for myself? And there, I think, is the crux of the problem. I think for the most part, where a small business owner hurts themselves is not surrounding themselves with the right people all the time. And the right people change as your business changes, right? There's no right person that's going to take you from inception to selling. But the key to the equation is paying for the right information when you need it to be successful. I'll give you a perfect case in point. We have clients that purchase real estate, whether it's for their business or for personal gain later on. And they love the real estate, and they go to close the loan, and they're going through the documentation, and they end up hiring their brother-in-law, who's a personal injury attorney or whatever practice of law outside of commercial law, because they saved $3,000 or $4,000 in legal costs, right? And that becomes a constant theme. I think that there's a worry that somebody's always trying to sell me something. As soon as a small business customer gets in a room, all the salespeople congregate next to them and they're trying to sell them stuff, right? And so it becomes what's real value and what's not real value. And it's hard to walk through those waters, but trying to go at it alone and not getting the right information is the worst mistake you can make, because I've seen it time and time again where a business customer finally has been putting their financial statements together. They're finally out trying to sell to equity people, and the equity person's ready to buy. They get an outside business valuation, and the numbers just don't support the sale price. So you're so happy you got a buyer. There's a good value there. You think you're like, I'm ready. And now all of a sudden the finance falls through. Why? Because I didn't want to pay Uncle Sam $5,000, but it just cost me $500,000, right? So it's really, information is the key, and I think it starts, that idea of game planning and goal setting has to start sooner than later. By the time you're ready to sell, it's too late. There's too many things that have to fall into place, and then it becomes more of luck than skill. And I for one, don't want to depend on luck. I'd rather know where I'm headed and what that outcome's going to be. It's tricky enough to be a small business owner nowadays and to be profitable, more or less trying to hopefully sell your business at the right time and for the right price. Get the right people and pay for them. It makes all the difference in the world.
You put together a team, you identify your goals, objectives, but before you can even do that, I think the business owners actually have to sit down with a licensed planner or somebody that they're comfortable with to go through what is it that they want from the business. Do they need a cash flow? What do they want to go to beneficiaries? Do they just want to leave a legacy? Do they want to leave money to charity? Do they want to minimize estate taxes? How do you take assets out of an illiquid business? How do you turn that into a cash flow down the road through trusts, et cetera? So it all starts there. Then I think the second step is what we talked about before, is identify, once you as an individual owner or partner know what you need from the business, then you go and you identify with your partners and or key employees what the goals should be, create a plan, and then you go to a team and then identify and then work it through with the professionals on the team.